Ladies and gentlemen, look at the RSP. This is the equal weight S&P getting absolutely destroyed again today following better than expected economic data. This is, and I don't say this lightly, this is the longest losing streak for value stocks in the history of forever. It's never happened before. 11 straight red days in a row. Heading into Powell tomorrow could actually set the markets up for a pretty nice rally. And we'll discuss that throughout this video. But I will tell you right now, the RSP does not look great. Now, this is not the value ETF. We'll look at that in just a moment. This is the equal weight S&P that has broken down now. You're now below your 50-day moving average. That's not great. You're down 0.61% on the day today. And look at the RSI. The RSI is at 36.45, showing no strength at all. The last time you hit a level this low was back here in April of 2024, and it did bottom out around this point on the RSI. Technically, you hit 32, so I mean, you're not exactly there yet, but you're pretty close to that level where you tend to get a bottoming. Now, what happened back in April is the RSP actually rallied about 6.2% following that bottom. Okay, now Powell could be a good catalyst for this, and I'll tell you why. Wall Street is concerned that Powell is going to come out and be hawkish. Okay, it's the weirdest thing that's going on right now, because on one hand, you have markets that are saying, yep, the Fed's going to cut rates 25 basis points with 97.4% certainty. And there's actually a 2.6% chance the Fed's going to cut rates 50 basis points. But then they're concerned about Powell being hawkish, about the Fed being hawkish. It doesn't make a whole lot of logical sense. What Wall Street is truly concerned about is the dot plot. Projections for the neutral rate and overall the path of interest rates. How many cuts are we going to get next year? Wall Street's expecting 3 cuts currently. Is that only going to be 1 cut? Does Powell throw on the table potentially raising rates? You know, is that a possibility? Okay, that's what Wall Street is concerned about coming tomorrow. Now, here's the deal. I don't think Powell is going to dramatically change his stance. This is not the meeting for that. It's just not. We don't know what tariff policies are going to look like. We don't know, how government spending policies are going to look like. I think at this point, Powell has made it very clear that he's not going to just change policies, from the Fed's perspective until they know what, the government deficit's going to look like, or government spending's going to look like, what tariffs are going to look like. So I'm not expecting much of a change from Powell coming tomorrow. I'm expecting the same old Powell that we've seen. One that doesn't back himself into a corner. One that is, just nauseously neutral, right? He doesn't take the approach of saying inflation's conquered. There's no issue there. He also doesn't take the approach to say we have this huge inflation problem, right? It's gonna be the same old that we normally get from Powell. And this will likely cause a relief rally for markets. I said this in the last video, and I will use this again. If you are like me and you're not exactly a fan of the dentist, you've had some horror stories from the dentist before, simple routine, just checkup cleanings make you a little bit nervous, okay? This is like, what we're kind of walking into tomorrow. People are nervous. And then before anything happens, really when you sit in the chair, you're not as nervous as you were before, right? Before you actually win, in the hours or days before, right? Okay, so that's kind of like the same kind of analogy. And then after you're cleaning, you realize you don't have any cavities, nothing's dramatically wrong with your teeth, and then you're really feeling relieved. That's kind of like what we can expect after the Fed tomorrow. I would be shocked if Wall Street gets any new information, if Wall Street does get some kind of big change from the Fed, it's highly unlikely. Okay, so from that perspective, that would really support markets and help boost things higher. Because let me tell you right now, you may think markets are frothy or euphoric or some of these other words that smart people have tried to use, quote unquote, smart people have tried to use. But the actual reality of the situation is Wall Street's pretty negative right now. Okay, CNN's Fear and Greed Index is at 52, neutral at best. Yesterday, you were greed at 56, but barely. Okay. Market momentum is greed. Stock price strength, extreme fear. Stock price breadth, extreme fear. Put and call options, extreme greed. And market volatility is neutral. Safe haven demand is neutral. And junk bond demand in extreme greed. Like, there is not euphoria out there. There is none. Okay. Let's forget that concept now. Okay. There is definitely room for a year-end rally. Take a look at this. This is even more alarming. You're seeing a breakdown in the percent of stocks trading above their 50-day moving average. This is down 4% today. So 4% of stocks are falling below their 50-day moving average just today. You're now sitting at 49%. 49% of stocks above their 50-day moving average is nowhere close to being bullish. You would want to like double these numbers, right? Almost double these numbers to get to something really bullish. Just for reference, on Christmas Eve of 2023, you were at 85% of stocks trading above their 50-day moving average. That was a market borderline euphoric, right? That maybe had rallied a little bit too much. At 49%, you're nowhere close to that. And I think there's a lot of room to get a relief rally in here. Even if we pop back to somewhere where we were just at, a week ago, 2 weeks ago, at like 67% of stocks above their 50-day moving average. That would be quite a rally from here. Now, today, we did get retail sales month over month that came in at 0.7%. The expectation was 0.6% month over month. And last month's number was actually revised up from 0.4% up to 0.5%. So across the board today, retail sales did come in a little bit better than expected today, which is actually good, right? You actually want to see good data. Okay, now markets are selling off because they're going, oh, wait, if we're getting good economic data, that means the Fed's going to be hawkish. The Fed might even raise rates. It's like a hypochondriac that, touches a piece of bad fruit or something. Like they freak out. They drive to the worst case possible, scenarios. Brain eating bacteria is going like, no, okay. That's not what this means. But yes, the economy's doing okay. That's great. Does that change anything for the Fed at this meeting at least? No. Okay. And that's where I think the relief will actually come in. Now, some people on X, like Liz Young Thomas, really just points out that the beat in retail sales really came from auto sales. And she questions whether or not this is just front running of possible tariffs and EV subsidy removal, meaning like let's say GM, for an example, right? Some people are going to go out and buy that new truck because they've heard on the news that things are going to be more expensive, that cars are going to be more expensive. So they go out and, buy the new car early. Or maybe it's, GM or Ford or whatnot that gets battery supplies from China. And they're like, oh, crap, we're about to get tariffed. We're not going to be allowed to get our EV battery material anymore starting here in the next couple of months. So they go ahead and they order a bunch of it now. Okay. I don't know if that's what it was, but you definitely seen, autos have a huge impact on the retail sales number. Overall, it doesn't change anything for the Fed or the markets. In fact, I would actually argue that's good news for the markets that the economy was stronger than expected. Ryan Dietrich on X writes, 11 days in a row with more decliners than advancers on the S&P 500 ties the longest streak since 1990. Many claim this is bearish, but is it? Looking at the longest streaks ever actually appears to be rather bullish. significant outperformance across the board 1 year later. You can see you're higher on average 73.6% of the time with a median return of 10.3%, which is definitely not a terrible year. Now, I don't want to confuse anybody because I still am concerned about valuations, largely on the headline S&P and comprised of big tech. I mean, if you look at big tech today, even Apple up 1%, like almost new all-time highs. Google's slightly green today, Microsoft slightly green today. All of these big tech names are trading at stupid multiples when you factor in the lack of growth that they really have, right? These are not super growth companies, and they're trading at super growth company like multiples. Now, each one's a little bit different, but let's say Apple, for an example, is not a super growth company. It's actually a no growth company. When you factor in inflation, they are negative growth over the last couple of years. Okay, should they be trading at a 30 times forward multiple? Probably not. I am concerned about valuations from that perspective, especially once we get into 2025, and I think that'll help fuel some of that rotation and broader market rally. Being reported today that the soft landing is the most likely scenario for the economy according to a Bank of America survey. A soft landing for the economy is the most likely scenario according to 60% of investors polled in Bank of America's December Global Fund Manager survey. This is where inflation is reduced without the economy slowing significantly. A total of 33% of respondents now expect no landing, where the economy grows in an inflationary environment. An 8-month high. Only 6% expect a soft landing, a 6-month low. The survey shows a hard landing is where the economy slows sharply or goes into recession. And that's another one of those weird dynamics, because I think the odds of a hard landing are definitely higher than 8%. Okay, like that's definitely wrong. And at some point, we may have to factor that in again. We might have to price that in again in Q1. Once you get what is called a growth scare, where you start to get some data sets that miss expectations. And that is where I see a problem coming in Q1. Mix that with high valuations, that's a cocktail for a pretty severe correction. But between now and year end, once you knock out Jerome Powell, this risk catalyst tomorrow, I think you then have momentum to rally to the upside. I don't think it's going to be really an S&P driven rally, though. I think a lot of it could just be a broadening out again of our markets. You've seen a narrowing of our markets recently. I think you could then see a broadening out of our markets once again. And I will point out, I mean, this is now like many red days in a row for the RSP. This has not been a strong market over the past 2 weeks or so, and you're probably overdue for just some kind of bounce anyways. And thus, you actually could be overdue for a little bit of a sell-off in some of your big tech names that have been carrying markets higher. So don't forget, tomorrow we do have some earnings pre-market with General Mills, ABM, Birkenstock, Toro, and Jabil. And then in after hours, we have Micron, Lennar, Generac, and then Thursday you have Accenture, Darden Restaurants, Cintas, Paychex, Conagra, CarMax, and some others. And then in after hours, you have Nike, FedEx, and BlackBerry that will report earnings. And then Carnival on Friday pre-market. So Nike, FedEx, Accenture, Darden, Micron, Lennar, these are going to be important names for their respective sectors. And then, of course, on Friday, or on Thursday, you're going to get initial jobless claims and final numbers for GDP quarter over quarter for Q3. And then on Friday, you will get PCE, personal income and personal spending. These are highly forecastable measures of data, though. So following retail sales today, following the CPI and PPI reports that we got last week, we kind of have a pretty good understanding of what that data is going to look like. So I think the Fed is really the biggest, quote unquote, wild card catalyst for this week. Although I think it's pretty obvious, the Fed's not really going to change their stance too dramatically. Okay? They're going to say, we're data dependent. We think inflation's coming down. The road's going to be bumpy. We're going to take this meeting by meeting, and there's no preset path to policy. And they're probably going to give us 3 rate cuts next year. Like, that's what the markets are pricing, and that's probably what we're going to get. If we get 2 rate cuts, is that the end of the world? No, that implies a stronger economy. Okay, so I don't buy into the fear heading into tomorrow. Obviously, could markets sell off? Yes, anything's a possibility. But I think we have a very high statistical probability of tomorrow being a buy the news event with the Fed. Again, just my opinion. Let me know what you guys think down below in the comment section. With that said, have a fantastic rest of your day, and I will see you in the next one.